I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a, multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1 worth of GDP. You get some numbers, 70, 80 cents. Forget about the multiplier. It's actually now, a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. And so, so gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's, well, I consider that a conservative forecast. And we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say, I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. And there's a number of different techniques. And what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But, it could go down tomorrow. And I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth, and risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all and I follow them all. But they've all been carried out feet first on this, bond bubble thing, the greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. When I say low, I mean, show me negative 4%. That's a low real rate. Yeah, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but inflation was 15%. And my borrowings was tax deductible, and the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about -7. That's a low real rate. So the point is, we have a long way to go. And it doesn't matter, people are interested in whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, and a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there, but you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does, and that will happen. And so, in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just, duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative. I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple of decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. What is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. Our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. You can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology? How do you get and by the way, it makes sense to save. If you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next. And maybe I better save more just in case, and so forth. So, and that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold. The bond market is telling a completely different story, by the way, and this is a little more esoteric, but if you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, they're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Eurodollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a a big red siren, flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I said, I'm going to borrow everything I can. And that creates a demand for funds, and interest rates go up. And then the recession hits, and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. Even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect. That unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. the fall of 2008. I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. And I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality, and I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot to say that there could be a rate cut in August. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes. And then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. The Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market, or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November, but the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil, they don't build pipelines, and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City, and that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you ran out, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You talk about 40% on credit cards in that world. And people forget, well, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were. Yeah, that's a pretty good summary. I started my career as a lawyer in the late 70s, but before I went to law school, I got a graduate degree in international economics. So I have that, that macroeconomic background, if you will, even before law. And then after getting out of law school, I started my career as international tax counsel for Citibank. So that's about as broad a platform as you can have. And then along the way, switched into securities and derivatives law, worked for an investment bank, major dealer in U.S. government securities. That gave me a pretty good background in federal finance. And then switched to the hedge fund world and was there from start to finish at long-term capital management. Made a few headlines in 1998, and I was the principal negotiator of that rescue by, people say I was rescued by the Federal Reserve. That's not exactly right. The Federal Reserve did convene a meeting of the banks to organize the rescue, but said to the banks, you have to do this. They were sitting in the boardroom at the Fed, kind of hard to say no, but they adjourned over to Merrill Lynch's boardroom a few blocks away on Liberty Street, and we took it from there. And it was one of those deals, 5 days, no sleep, nobody's shaving. At first the jackets come off, then the ties come off, then the shirts are unbuttoned, and everyone's got a beard. Nobody slept, but we got it done, brought it in for a soft landing. After that, around an electronic stock exchange for a while, but was tapped by the CIA to help them with counter-terrorist finance after 9/11 and worked for them for 10 years. That's what we did. We invented a new branch of intelligence called MarkInt for market intelligence, basically getting actionable intelligence from capital markets information, which had never been done before. There's the INT stands for intelligence. So HUMINT is human intelligence. SIGINT is signals intelligence. We invented MarkInt, or market intelligence, that took on a life of its own. But along the way, was just got literally a cold call from a top literary agent. She heard an interview I did on NPR's Planet Money. She's an NPR fan, and introduced herself and said, how would you like to write a book? And so I said, I hadn't really thought about it, but let's talk. And we had lunch, hit it off. And then that led to book projects. And now, 7 books, and 10 years later, here we are. So you can either say I had an eclectic career, or I didn't what I wanted to be when I grew up, but I've done a little bit of everything from banking, capital markets, hedge funds, national security, intelligence, work with the Defense Department, and written a bunch of books.
Well, it's great to have you here. The first book, which came out 2011, was Currency Wars, The Making of the Next Global Crisis. And you certainly touch on a lot of currency dynamics, which are certainly prescient to what's going on today in the latest book, The New Great Depression here. When did you start writing this book? It's just come out in the past week, but it just seems so relevant and timely. I mean, you must have had some pretty fast turnaround on this thing, right?
We did. I got the call from my agent, my publisher, late April, and of course, then we were in the thick of the first wave of infections and fatalities, sadly, and quarantine and lockdown and all that. And the stock market had just dropped 30%, over 30% from February 24th to March 23rd. And so they said, we really want to book on this. It's really important. There's going to be huge interest in this. And can we do this? And I said, sure. And our original target date was July 15th. We were trying to come out on July 15th. And that's what we work towards. So I said, so basically, given the target length and the outline, I was going to write it in about 40 days, 45 days. If you do 2,000 words a day, you can get there, but that's a lot of writing. So I said to my wife, well, there's good news, bad news. The bad news is for the next 30 days, I'm going to be the most antisocial person you ever met. The good news is we'll have a book behind us and we'll get that done. And that's pretty much what we did. I worked really hard straight through and kind of writing in the morning and reading at night, and almost like researching, doing the research at night, and then waking up the next morning and writing up the research and other observations. And it was all happening very quickly. I mean, obviously the disease was expanding, the economy was collapsing, but the amount of academic literature on the subject was, you're getting 10 papers a day coming from all over the place, and that was good, but it was an enormous amount. But when I first discussed it with my publisher, they said, well, Jim, we think you're great on the economy and capital markets and central banking, and all that's really important, and that's what we want you to write about. But keep away from the epidemiology and the immunology, because you're not a scientist, you're not a doctor. And I said, hold on, that's like asking someone to write about property damage in New Orleans in 2005 and not mention Hurricane Katrina. I said, you can't do that. You obviously, the pandemic is the catalyst or the cause of the depression, and you can't understand one without understanding the other. So I said, I'm going to do both. I teased her a little bit. I said, well, I do have 2 degrees from Johns Hopkins, so I'm not intimidated by natural science. I'm not a doctor, of course, but I'm comfortable in the field. And when I approached it, when I started doing the research, so by the way, Alex, this is the first book that deals with both the pandemic and what I call the new Great Depression or the economy. There will be lots of books written on the pandemic. Doctors have already written some. They're out there. There'll be books written on the economic crash and what's going on. Although it's a funny thing, economists actually don't write that many books. There are some, other than textbooks. Textbooks can be huge money makers, kind of boring, but there are a few economists who write books. Paul Krugman does, and Barry Eichengreen, and a few others. But generally, economists prefer to write papers, journal articles, monographs, and things, because they're usually wrong and they're changing it. So you write a paper and you're wrong, well, just write another paper. Writing a book, you go out on a limb a little bit, because if it's going to have any kind of shelf life, you have to lean forward and do a little forecasting. And I have ways of doing that are better than what Wall Street and Washington do. But you're still you're out on the limb a little bit. But I'm comfortable, and I've done that before. But on the medical side of it, I read over 100 peer-reviewed journal articles. Obviously, top publications like The Lancet and the New England Journal of Medicine and others, but others that were top tier, maybe less well known, more specialized. But these papers were coming out left and right, and other evidence was coming out. And when I started doing the research, I said, well, this is going to be straightforward. There's a bunch of conspiracy theories and fringe theories and just wacky, speculation over here. And there's a lot of good science by reputable clinicians and PhDs over here, and just kind of discard this and focus on this. And that's what I did. But what I discovered, it was easy to discard the junk. But when I got into what I'll call real science, I discovered quickly that the scientists don't agree with each other. I can show you papers that say, you're a fool to go out without a mask. Masks are the key to this whole thing. Everybody mask up. That's the way we get a handle on the pandemic. I can show you other papers by equally qualified people, PhDs in virology and epidemiology, who say, no, masks don't work. The virus is too small. It goes through the weave. They're improperly constructed. We don't wear them correctly. And they don't do much good. It's kind of virtue signaling. But my point is, without even taking sides in that, just as a writer, and I did present both views, and all that information is in the endnotes. The book has over 200 endnotes, and they're all fairly technical. So I tell people, if you don't like something I said, don't argue with me. Go to the footnotes or the endnotes and argue with the scientists. But I tried to, when there were divisions like that, I tried to represent both sides fairly. But I usually do come down on one side or the other based on my own view of the evidence. So that made it more challenging. And then you also have this whole, where did the virus come from? I have a chapter on that. Well, there's the wet market theory, which I thought last spring was a lie, basically Chinese propaganda. That's even more apparent today. You have the laboratory theory that it came from a laboratory, particularly the Wuhan Institute of Virology. Good evidence that was the case last spring. That's much stronger today. A ton of stuff has come in literally in the last couple of weeks, bearing that out. But that's how I came out in the book. I said it did come from the laboratory, but that's another area where, again, I can find top scientists with both points of view. I did learn in reading these scientific journal articles, there's always an abstract that the authors, their affiliations, the abstract, and then the main paper. I would go right to the last page and look at who paid them, because they're, modern practices. You disclose your sources of research grant. If I saw you were paid by the Chinese, I discounted you about 50%. I might have included it, but I certainly took that into account.
We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good. Goldilocks, soft landing. Fed's going to get the memo. They're going to cut rates, the pivot and buy stocks. The bond market is saying, no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away, or less interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. A lot of business people are living in the real world, in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow while you can. You're like, hey, this is a really bad recession coming. If I got lines of credit, I'm going to use them up. Now, I don't want my bank changing the terms. I don't want material average change clauses kicking in and said, I'm going to borrow everything I can. And that creates a demand for funds. And interest rates go up. And then the recession hits. And the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loss. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market is telling us, Goldilocks, bond market's telling us, here comes Hurricane Mitch, or whatever. And then there's what I call the reality. What I see is kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed is probably over-tightened. They're going to keep going for reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. We've seen this movie before. This is exactly what happened in 2018. I don't know. Attention spans seem to be short these days, but it was not long ago. Go back and look at a chart, any stock index chart, from October 1st, 2018 to December 24, 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow. So maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when I think NASDAQ dropped like 3% in one day. Now here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market. This whole Bernanke put and Greenspan put and all that, that's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the keyword. Stocks are going down, but it's kind of 0.5% a day, 1% a day, trending down. Lower highs, lower lows trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008. I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer entrepreneur and you're in any kind of not as many customers walking in the door, you'll do everything you can to avoid laying people off. Be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and rolling terminations, etc. It's a lagging indicator. We know enough right now to know that number is going up this spring, but that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment is a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on annualized basis, 5.2% on annualized basis. I'm like, yeah, and inflation is 7% or 6%. So your real wage just went down 1 or 2 points because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal. And you have to subtract inflation to find out what's happening to real wages. And the answer is, real wages have been going down for a couple of years because it runs around 5% annualized, give or take. Sounds like 5% raise. What do you want? Well, yeah, but with 8, 9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. By the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. That's all you do. It's not sophisticated. And that number today is around 61.2, give or take percent. But as recently as 2000, that number was over 70% and has come down ever since. And it dropped like a stone during 2020. During the pandemic, lockdown came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population, not working. You're a homemaker. You're a student. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low, and the trend has been down. So that leaves relative to kind of a normalized number. That leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's the depression level of unemployment.
Notably in 1980 and 1981, regrettably, analysts anticipate that the recession will surpass expectations, with the bottom potentially falling lower than predicted, perhaps a 30% to 50% decline in the S&P, around 22,100. While we had a brief respite between 2020 and 2023, the situation is worsening in 2023 due to the concurrent financial crisis. The financial crisis is currently brewing, causing widespread panic. If it materializes, the impact will be severe. marking a dark day for America and the world. It's important to note that each financial crisis carries its unique level of impact, ranging from substantial to less significant losses. Predicting the scale and duration of a crisis is challenging, as evidenced by the subprime mortgage crisis from 2007 to 2008, which coincided with a recession, resulting in a disastrous outcome. The expansion of mortgage credit triggered this crisis, enabling widespread borrowing and mortgage acquisition. This mistake led to the collapse of the U.S. housing market, causing many to lose their homes, savings, and jobs. The repercussions extended globally given America's pivotal role in world trade. Discussions on recession, inflation, and deflation aside, one aspect yet to be addressed, referenced earlier, is the possibility of a global liquidity crisis. In 1998, despite the absence of a recession, the financial world faced a near collapse. Such crises can coincide with recessions, resulting in severe consequences. A notable instance is the subprime mortgage crisis from 2007 to 2008. There's speculation that 2023 might witness a collision between a financial crisis and recession, resembling the 2007-2008 scenario. Financial experts, including Jim Rickards, highlight signs indicating such a development. These signs include a diminishing world trade, daily declines in industrial output coupled with rising unemployment, and historically high interest rates for the past 15 years aimed at combating inflation but failing to curb inflated prices. If there are lingering doubts about the recession and financial crisis, examining the recent state of American banks provides clarity. In just a month, 5 major banks have faced setbacks, such as bankruptcy, FDIC takeovers, and collapses. The combined losses of credit and stockholders from these events surpass $200 billion, sending a clear signal of systemic issues. Efforts by the FDIC to reassure the public include unconventional measures, such as guaranteeing depositors sums exceeding $200 billion for Silicon Valley Bank and Signature Bank. These unprecedented actions, while seemingly noble, are predicted by Jim Rickards to deplete the FDIC insurance fund, ultimately affecting consumers. Moreover, the Federal Reserve's decision to extend more loans to member banks through the Bank Term Funding Program, BTFP, is causing significant turmoil in the U.S. banking system. These moves have intensified public anxiety, particularly among depositors. Concerns arise regarding whether these actions aim to implement new policies or if they are motivated by the interests of a few affected entities. The parallels to the 2008 crisis, where the FDIC guaranteed all bank deposits, echo in current events. As the government faces unrealized losses exceeding $700 billion in U.S. bank portfolios, the continued cash provision to depositors raises concerns about the sustainability of the banking system. The looming question is whether the crisis is truly over, or if the panic is just beginning. Drawing parallels with the 2008 financial crisis, which started a year and 6 months before reaching a critical stage, the current crisis, only a month old, has already led to the downfall of 5 banks. Addressing the broader economic situation, the FDIC's guaranteeing of all depositors and the Federal Reserve's offer of additional loans through BTFP signify pervasive issues. The Fed's guaranteeing of all bank deposits, surpassing the $250,000 insurance limit, echoes actions taken in 2008 to avert bank runs. However, such measures may strain the FDIC insurance fund, with potential consequences for consumers. As the government grapples with increasing unrealized losses in U.S. bank portfolios, the fear is that continuous cash provision to depositors will hasten the collapse of the banking system. Despite attempts to reassure the public, it remains uncertain whether the crisis is truly averted. The interconnectedness of the banking system and the broader economy becomes evident, reflecting a situation that extends beyond individual instances. The Fed's unusual actions, coupled with the FDIC's extraordinary measures, intensify the prevalent challenges. Considering the gravity of the situation, the looming question is, what should one do? How does one respond to the panic and secure oneself against the impending crisis? While the inevitable cannot be avoided, taking proactive steps to preserve wealth becomes crucial. According to Jim Rickards, the first step is acquiring gold.
Down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here.
The renowned economist Jim Rickards continued her speech as follows. The supply chains are deteriorating, but these disruptions in the supply chain did not originate with the conflict. They didn't even commence with the pandemic. They initiated with the trade war led by Trump in 2018. I discovered an excellent book on this topic, authored by Luan Larocco. What's intriguing about her book is that she completed it in late 2019, serving almost as a control experiment. It predates the pandemic. It's convenient to attribute the disruption in the supply chain to the pandemic, which indeed played a role. And the conflict also had its impact. However, we have a meticulous examination of the supply chain's condition before either event, and the conclusion is, it was chaotic. It was chaotic back then due to tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That may seem straightforward because Brazil cultivates soybeans. Well, guess what? You have to transport the ships to Brazilian ports. You have to reorganize all the logistical lanes. That was already happening. The pandemic exacerbated it, and now the conflict exacerbates it even more. Yes, the world is fragmenting. We're disengaging. Globalization is concluding. There will be a new iteration of it. It's not the termination of world trade, but you might witness perhaps the Five Eyes, UK, US, Canada, Australia, New Zealand, and allies in Western Europe forming a new trading bloc while excluding China and Russia. It will resemble somewhat the Cold War. I discussed this with Paul B. However, in the 70s, something similar occurred. It commenced with cost-push inflation. It was the Arab oil embargo in 1973 after the Israel-Arab War. Then the Arabs imposed the embargo on us, quadrupling the price of oil from $3 a barrel to $12 a barrel. It might sound inexpensive, but that's a 300% increase. Subsequently, we experienced a severe stock market crash and recession in 1974, the most severe since the Great Depression at that time. We've encountered more severe ones since, but back then it was the worst recession since the Great Depression. Following that, the Fed intervened and Nixon abandoned the gold standard. Nixon implemented an accommodating monetary policy in '72, a bit earlier for his re-election effort, etc. So, here comes inflation, but along the way, and then there was another oil embargo, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were dual oil shocks. It was a supply-driven cost-push inflation. However, it transformed into demand pull. It evolved into a demand-side scenario that I lived through. I was a young, up-and-coming lawyer at Citibank. a senior officer living in New York City. That was a time when if you desired anything new, furniture, TV set, vacation, anything, you rushed out. You dropped everything, rushed out, and did it because the price was escalating so rapidly. This is instructive in two ways. Firstly, it illustrates that the Fed is consistently behind the curve. It shows that these issues can persist much longer than anticipated. But more crucially, because I believe things will happen more swiftly now, it demonstrates inflation shifting from cost push to demand pull, transitioning from a supply-side matter to a psychological shift on the consumer side. Volcker managed to suppress it, but at a substantial cost. Unemployment reached approximately 11%. He elevated interest rates to 20%. How does that feel? Mortgage holders, student loan holders, and others? 20%. We're talking about 40% on credit cards in that era. People tend to forget, well, doesn't inflation mean you have high growth or whatever? At least low unemployment. No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We experienced 3 in 1974, 1980, and 1981, which persisted until 1982. By the way, people lost confidence in the dollar in the late 70s. Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now it was Treasury.
Slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but the market has their own dynamic. They're saying, well, if the Fed raises rates the way I described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned, because as I say, the Fed's going to over tighten.
Now, why isn't the Federal Reserve aware of this? Well, because they never are. Because they have the poorest forecasting record of any institution I can think of. Their entire history since 1913 is one mistake after another, and this will just be the latest in the long series. So just to kind of recap, the Fed is on a trajectory. We know precisely what it is because they informed us. All you have to do is listen to them and believe them. They're going to increase rates, let high rates do their work, and observe the inflation come down, and maybe in 2024 decrease rates. What I anticipate is they are going to raise rates for the next couple of meetings exactly as I've outlined, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to conclude on, I can't call it a joyful note, but a global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like a liquidity crisis? No, a recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, the recession or depression and a financial panic converged, so they can happen together, but they don't have to. They can happen individually. What we're in for visually looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? What people don't understand is that behind the curtain off-balance sheet, this is off-balance sheet. You've got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with quadrillion, 1 quadrillion is 1,000 trillion. So, I just said the Fed printed $9 trillion. Maybe it's down to 7 trillion, but you have $1 quadrillion of derivatives, and they have to be supported with collateral. Not 100%, not even 10%. I mean 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this $1 quadrillion inverted pyramid of derivatives. And right now what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year treasuries as collateral. The only collateral I want are short-term U.S. Treasury bills. Treasury bills have a maximum maturity of 1 year, 360 days, but there can be 4-week bills, 8-week bills, 6-month bills, etc. That's the best form of collateral. It's the most liquid, easily traded, low volatility, easy to repledge, is by far the best form of collateral. That's all the banks want right now. But if you're a foreign bank, you need dollars to buy the dollar-based collateral. If you want treasury bills that are denominated in dollars, you need dollars to buy the bills. That's why the US dollar is so strong. People go, wait a second, the US has a multi-trillion-dollar annual budget deficit, a massive trade deficit, 132% debt to GDP ratio, $31 trillion in debt. You're going into a recession. How can the dollar be so strong? The answer is everything I just said has nothing to do with the demand for dollars in international foreign exchange markets.
I was having dinner with a friend not long ago in New York City. We met at a place called Oriole, which is in Midtown. My dinner companion that night was a senior advisor to BlackRock. As you may know, BlackRock is now the largest asset manager on the planet. It directly manages $5 trillion in assets, and it oversees another $11 trillion through its Aladdin platform. That means one firm controls more money than the GDPs of China, Russia, and Japan combined. Anyway, my dinner companion happens to work directly for BlackRock's CEO. As we nursed our white wine and the evening wore on, she let something slip. If I remember her words, she said something like, "They want to tell us we can't sell." What was she talking about? Who was she talking about? I placed a few calls, first to my contacts in Washington, then to a few people on Wall Street. Soon I was on a plane for a series of meetings to London, to Geneva, back to New York, then down to South America. As I began connecting the dots, a pattern emerged. It revealed a network of more than 189 individuals positioned inside the world's major financial institutions. Some of them hold senior positions inside the IMF, World Bank, and every central bank in the G20, including our own Federal Reserve. These elites share one vision, and they're about to make it a reality. That vision is one world order, one world taxation, and one world money. They've worked for years behind the scenes preparing to realize that vision. They've literally rigged the laws of international finance. Everything is basically in place right now, and there's essentially no way to stop this from happening. When the crisis hits, they'll flip the switch, freezing the global financial system. That will give them time to reset the world economy according to their vision. As the coming crisis unfolds, President Trump will be powerless to stop it. In fact, trying to stop them would probably weaken the president's power altogether.
That is amazing. Jim, really? So what do these elites want from your contact at BlackRock?
Basically, they want to classify BlackRock as too big to fail. The technical term is Systemically Important Financial Institution, or SIFI. That designation normally applies to banks, such as Bank of America. If your bank gets the SIFI label, it means the government will bail you out first in a crisis. But it also means you must turn over control of your bank until the crisis subsides. In this case, they're trying to reclassify BlackRock, an asset manager, as too big to fail. If they succeed, they'll be able to freeze BlackRock when the crisis hits. BlackRock clients won't be able to sell. They won't be able to buy either. Their accounts will go dark indefinitely. And the elite operatives will take control of BlackRock's assets remotely via the internet. But our research shows that their ICE 9 plan goes much, much deeper than that.
You refer to their plan as ICE 9. You just said that. What does that mean?
It's a reference to the Kurt Vonnegut novel, Cat's Cradle. In the book, a mad scientist creates a new form of water molecule called ICE 9. When it comes in contact with other water molecules, it freezes them at room temperature. One drop of ICE 9 can freeze the whole ocean. And that's what these elite operatives are about to do to the world economy.
Now, can you share with our viewers exactly who these operatives are and what their ultimate goal might be?
Like I said, John, more than 189 elite agents have slowly wormed their way into leadership positions across the board. They now sit at or near the head of the IMF, the World Bank, and even our own Federal Reserve. They also control much of what happens at the central banks of China, Russia, India, Brazil, Canada, and Europe. As you know, these institutions form a kind of global superstructure. It forms a kind of snare net encircling all nations. Their leaders aren't democratically elected. They're not accountable to you and me. They're beyond the reach of government and citizens, and yet they hold the fate of the global financial system in their hands. To get a sense of how they operate, imagine an array of floating spheres. One sphere is labeled IMF. One is labeled Fed. One is labeled Bilderberg. One is labeled Wall Street. One is labeled central banks. One is labeled intelligence agencies. One is labeled media, and so on. The elites inhabit all of these spheres, and together the network forms a kind of 3D Venn diagram. As I see it, regardless of what sphere they inhabit, the elites all share the same vision: one world order, one world taxation, and one world money. All of their actions are geared toward moving that agenda forward.
Are you able to share the identities of these elites with our viewers?
We've identified more than 189 individuals who are in many cases hiding in plain sight. Regardless, they all share the same vision: one world order, one world taxation, and one world money. A short list would include Christine Lagarde, Managing Director of the International Monetary Fund, IMF; Mark Carney, Governor of the Bank of England; Raghuram G. Rajan, Vice Chairman of the Bank for International Settlements; Haruhiko Kuroda, Governor of the Bank of Japan; William C. Dudley, President of the Federal Reserve Bank of New York; Agustin Carstens, Governor of the Bank of Mexico; Janet Yellen, Chairman of the Board of the Federal Reserve System; Mario Draghi, President of the European Central Bank; Zhu Min, former Deputy Managing Director of the IMF; Zhou Zhouquan, Governor of the People's Bank of China; Robert E. Rubin, Chairman of the Council on Foreign Relations. This A-list of central bankers and other elites is just the tip of the iceberg. Of course, not one of these elites will tell you outright what's going on, but I've seen and heard enough to connect the dots for myself. Not long ago, for example, I met with one of their senior operatives. He's a leading economist who served as the chairman of the Federal Reserve during the last crisis. He's considered one of the most influential minds in banking today. We met privately during a conclave in Seoul, South Korea. I came away from my meeting with him stunned and convinced that ICE 9 was real. Not long before that, I set up a one-on-one meeting with another member of the network. His name is Zhu Min, the former deputy governor of China's central bank. Until recently, he served as deputy managing director of the International Monetary Fund. Zhu is a brilliant guy, like Bernanke, and he's pleasant and well-meaning. There's no doubt in my mind that he's also a member of the elite network preparing to impose ICE 9 on millions of Americans. But I wasn't done with my research. I have since met with dozens of senior officials, intelligence analysts, and former Wall Street colleagues. My quest led to a final meeting, a face-to-face summit with the head of Bilderberg. We met at Rockefeller Center in Manhattan, and he was very eager to get my take on the euro as a currency. I was happy to provide it, of course, in exchange for some valuable intelligence. As I say in my new book, he did not have horns. In fact, he gave me a nice gift when we parted ways, a blue Swedish vase. I keep it in my writing studio at my home in Connecticut. But my point is, I came away from all three meetings convinced of one thing. When the next crisis hits, the elites are planning to freeze the financial system, and they'll replace it with a new system, one not based on the U.S. dollar. When that happens, we'll wake up to a very strange and disturbing new reality.
And for our viewers that are watching today, what might their reality look like that morning? How does this manifest?
First, they'll have gone to bed knowing that a massive financial crisis was underway. But when they wake up, they'll find it has worsened and the contagion has spread worldwide. When they go to withdraw money, their ATM will say, closed temporarily. When they go to sell stocks, their account will say, transaction not available. When they go to their local business, that business will only accept cash if it's open. As citizens realize they're being barred from their money, riots will erupt. It's going to get really bad really quickly.
How would such a freeze actually work? And wouldn't that be highly illegal?
Well, it wouldn't be illegal technically because they've been quietly laying the groundwork for years. They rigged the financial laws, changed the rules of the game to allow this to happen. The stage is set. They have the levers in place. The lights are positioned. Now someone just needs to flick a switch and they'll impose ICE 9 rapidly. And again, all of this will be legal because they rigged the system in their favor. Here in the U.S., for example, Congress pushed through something called the International Emergency Economic Powers Act, or IEPA. This allows the government to freeze accounts, assets, even whole institutions at will. The only condition is that there's some threat to national security with a foreign connection. Of course, with a global market, every financial crisis has a foreign connection. Any systemic crisis fits the bill. And the thing is, when the next crisis hits, it's going to be so bad, President Trump won't have any choice but to go along with the elite's plan.
You have to admit, that sounds somewhat hard to believe. Now, how could these operatives actually freeze the whole country's financial system?
Well, fortunately, we have some recent real-life examples to study. The elites have been conducting a series of dry runs for years, leading up to ICE 9. Look at Cyprus, for example. A few years ago, the Cypriot economy was in trouble, especially the banks. The IMF stepped in and loaned Cyprus $10 billion, but the loan came with strings. Now pay attention because this is precisely what they're going to do. But imagine it on a global scale. So in exchange for the capital injection, the IMF demanded control over the Cypriot banking system. More specifically, the IMF froze the entire system, literally every bank in the country. And they did that to ensure the IMF's demands were met, including strict capital controls.
Jim, these insights resonate strongly. Our audience surprises me with their understanding of complex topics when we discuss them. Many are well-versed in these matters, easily grasping the crucial elements available to those who know where to look. We've recently recorded an exclusive video discussing an upcoming geopolitical shockwave, a major development in global finance since 1971. We'll also offer strategies for individuals to benefit from this crisis. Regarding the economic situation, you've pointed to the Biden administration for depleting our oil reserves significantly, surpassing all previous presidents. The ongoing conflict in Ukraine adds to these challenges. How much blame rests with the president versus supply chain issues? And as we're about 17 months away from an election, where do we currently stand?
It's a great list, Brian, because you can say, well, we could talk about the war in Ukraine. Yeah, we could talk about monetary policy. We just kind of did go through some of the recession indicators. We can talk about the election. But they're all connected. I mean, that's really where the complexity theory and the density of the network comes in, because these things are all connected. So just to spend a minute on Ukraine. By the way, I just last week I do this annually, so it's been 8 years in a row. Conducted a seminar on financial warfare at the U.S. Army War College in Carlisle, Pennsylvania. And it is at the Army War College, but there are people there from all branches. It's a very elite group, handpicked about 12 students, mid-career officers. So they're kind of late 30s, early 40s, lieutenant colonels. And from all branches like at Marines, Army, Navy, Air Force, Marines, and a few civilians, State Department and CIA, NSA, intelligence community. But it's a fun group. 1,213. I look at the resume. It's amazingly accomplished. They all have multiple master's degrees, the occasional PhD, speak 4 languages, been deployed from Iraq to Colombia or wherever, but they've been handpicked as the future big brains. These are people. 5 years from now, there'll be 3-star generals on the National Security Council, etc. It's a fun class, and my topic is financial warfare, which is kind of like finance and warfare, which is what we're mashing up right now. And I spent a lot of time talking about this whole BRICS thing, and we can talk about that if you like. But I tell interviews like this, Brian, I always explain. I said I didn't say anything in the U.S. Army war colors that I'm not saying in this interview. It's not like I have a secret package for them and we do something else. I just say the same thing. You can take it or leave it. You can agree or disagree. But it's a great group, very interactive. But I was talking about the Ukraine war, and I said one of the most difficult things about this is getting reliable information in a war. Everybody lies. So the U.S. lies. If you ask me what has surprised me about the war, the conduct of the war, the development, hasn't really been a surprise. Russia was always going to win. Just question how long. It's tragic. But I'm surprised at how many warmongers there are in the know. They're mushy. Germany's between a rock and hard place. Hungary is actually against the no. Again, a little. Sorry. The US has the warmongers, I know that. But starting with Boris Johnson and going to Rishi Sunak, I mean, they're more bloodthirsty than the Americans, and they're the ones providing the Challenger tanks, etc. I don't quite get it. I think all these Chamberlain, Churchill, Hitler metaphors fall down. I mean, I know history. I know what Chamberlain did. And I know Winston Churchill was one of the great heroes of the 20th century. But I don't see that parallel. Are they doing it to try to get a better trade deal with the US? Is it that simple or no? Well, it disappoints me to see the UK act as kind of lackeys of the... It's sad to know it's not the heyday of the British Empire, but it's one of the largest economies in the world. Major financial center, nuclear power. I mean, it's not like it's a tertiary power, but I see what's going on. But I have to say I don't understand it. I don't see why the UK can't go their own way a little bit. But they are, so they're not. But not to get too immersed in the positive. You can pretty much lay the entire Ukrainian tragedy at Biden's feet because Ukraine would not. Russia would not have invaded Ukraine in February of 2022 if they hadn't been provoked for 14 years. I mean, going back to 2008. So what happened in 2008? George W. Bush stands up at a NATO summit and says Georgia and Ukraine should join NATO. He just said that. 3 months later, Putin invades Georgia. That's right. 2008 Olympics. So Bush says Georgia and Ukraine should join NATO. Putin almost immediately invades Georgia and takes the place over. It's like, were you not paying attention? Did you not get the message? And we had the global financial crisis and a lot else. So fast forward to 2014. What happens? They have an election in Ukraine. A pro-Russia, pro-Putin president wins. You can debate election. How high quality was the election? You can say, I don't like the guy, but he won. There actually was an election. And within months, the MI6 and CIA working with neo-Nazi elements in Ukraine. And they've been there since the Second World War. Overthrow the guy. They basically had the Maidan Square color revolution, so-called, which is all orchestrated by the intelligence agencies. They got snipers. They're killing people. The anti-Russian Ukrainians were doing the killing. And then the guy flees for his life, goes to Russia, and the US installs a puppet. Wasn't Soros funding Vice to go there and cover it in the central square? Correct. Yeah. And Victoria Dolan's behind the whole thing. She's got blood coming out of her mouth. I don't. So Putin's like, wait a second. We had an election. The pro-Russian guy wins. And you stage a coup, de facto coup, and kick him out and put in a puppet. So what does Putin do next? He invades Crimea or Nexus. Crimea takes it over. So it's like, okay, Georgia should join NATO. He invades Georgia. Ukraine should join NATO. We just had a coup. He takes over Ukraine. Are you not paying attention? You meaning the West, us, UK. Are you not paying attention to what's going on here? And then they sponsored anyway, without getting. They sponsored attacks on the Russian-speaking part of Ukraine, etc. So by Putin's at the end of his rope now, yes, he did invade.
At a very high level, I would say there are numerous challenges and obstacles. We'll discuss all of them in detail. People attribute words to you and sometimes give you the reputation of being a pessimist. Jim Rickards is always discussing the apocalypse, which I do not. I never use that term, but I emphasize that despite the hardships, we don't have to be victims. We are not powerless. We don't need to withdraw from challenges. The crucial thing is to anticipate them. If you can foresee upcoming events, you can address them appropriately. You can navigate through them, not only preserving your wealth, but also potentially profiting. I frequently cite the case of Augustinus, and people might ask, who is he? He was an industrialist in Weimar, Germany, in the early 1920s, and he could foresee hyperinflation long before the middle class or anyone else. He borrowed a substantial amount of Reichsmarks, which was the currency at the time, and invested in industrial assets such as coal mines, vessels, and natural resources. When hyperinflation arrived, he allowed some time to pass, then repaid his debts. I would say he paid back a negligible fraction of the original debt, almost insignificant, but he repaid it while the currency was essentially worthless. He retained all the assets and eventually became the wealthiest individual in Germany. My German skills aren't excellent, but his nickname was the Inflation, signifying the Inflation King. There are other similar stories as well, like Joseph Kennedy during the 1929 crash. So, once again, we are not powerless. We can take action, but the key to empowerment, as I often stress, is anticipation. This is where thorough analysis plays a crucial role. You might wonder, am I more intelligent than others? Of course not. Many brilliant minds exist, but people often rely on flawed models. There's a lot of behavioral psychology behind it, such as confirmation bias and the belief that the future will resemble the past, which is often not the case. So, if you adhere to those models, you'll likely achieve poor results. It's difficult to think of an institution with a worse track record in forecasting than the Federal Reserve. The U.S. Federal Reserve, and perhaps the IMF is an exception, both have notably poor records. You could almost take take the Fed's forecasts, do the opposite, and do just fine. There's more to it, but they tend to adhere to these flawed models. However, if you comprehend how the economy genuinely functions, understanding that it's a complex dynamic system, my approach is to apply complexity theory. Complexity theory has been around for quite some time, dating back to the Big Bang, the ultimate complex dynamic paradigm shift or phase transition that occurred around 13 billion years ago. However, the mathematical understanding of complexity theory emerged in the early 1960s. It has found successful applications in physics and other fields. I simply transferred it to capital markets, recognizing that capital markets are among the most complex dynamic systems, and adding human behavior to the mix further increases the complexity. These models work brilliantly when you have the right ones, but convincing others to understand and employ them can be challenging. Once again, the point is that with the right models, which should include behavioral psychology, a significant dose of history, complexity theory, and other branches of applied mathematics, you can achieve exceptional results. On the other hand, sticking with models like the Phillips curve and the non-accelerating inflation unemployment rate, as the Fed does, is likely to lead to errors. Does the future have some degree of resemblance to the past? Not always. In fact, it may occur less frequently now than ever before. Additionally, these models assume that prices change continuously. Prices fluctuate, of course, but markets don't always move smoothly. When they do, it often happens when you're not paying attention. When you are, they experience sudden gaps, either up or down. You might blink, and the market is at an entirely different level, having been revalued. Even though you can still enter or exit, you may have gained or lost a substantial amount of money in the blink of an eye. Considering these characteristics, and this is how I began to deconstruct the conventional wisdom, I realized that markets are not efficient, which is a flawed notion. They don't move continuously and gradually. They gap. If you're unprepared for this, you'll miss opportunities. Nothing in this context is entirely risk-free, so I started there. I began identifying the factors that, in my view, were inaccurately applied. You might ask, what resembles these characteristics? The answer is a complex dynamic system, the kind that generates hurricanes, tornadoes, lightning strikes, power outages, earthquakes, and tsunamis. All these phenomena result from complex dynamic systems. An earthquake doesn't sneak up on you. The ground suddenly shifts beneath you. Similarly, in financial markets, sudden and significant shifts occur. Therefore, I started to consider this as a more accurate model. Of course it is. Everything continually evolves. Another intellectual tool I use, which involves applied mathematics, is Bayes' theorem. Without delving into excessive detail, I learned about Bayes' theorem during my time at the CIA. I always say that if you have all the facts, a smart high school student can solve the problem. However, intelligence agencies and individuals in capital markets must solve problems when they don't possess all the facts. They have no choice. It's a matter of national security and defense or preserving one's financial well-being on Wall Street. You can't simply throw your hands up and say, "I'll wait for more facts to emerge." That approach doesn't work in the real world. Janet Yellen seems a bit detached from this reality. So, how do you solve problems when you lack complete information but still need to address the issue because it's approaching you? Bayes' theorem suggests assigning an initial probability and a priori assumption. You don't invent it, but you do your best, recognizing that you're working with incomplete information. If you have no facts at all and it's a binary outcome, assign a 50-50 probability. It's not precisely 50-50, but for a binary decision like red or black on a roulette table, it's slightly less than 50-50, but close enough. You say, it's either going to be red or black. I don't know which, so I'll assign a 50-50 probability. Subsequently, as new facts emerge, you update your model. Your probability either increases or decreases. If it decreases by a substantial amount, you discard that assumption, recognizing it was incorrect. You start over. However, if it increases, you're making it more likely that your initial assumption was correct. Over time, you can raise that probability to 80% or 90%, which isn't 100%, but it's quite robust. There's a crucial aspect to consider while updating, which was explained to me by Henry Kissinger. Imagine a simple simple graph where the vertical axis represents the probability of a specific outcome and the horizontal axis represents time or the amount of information you possess. Initially, at the start, you have little to no information, but you have ample time and flexibility. However, as you progress along the timeline, your information increases, which is a positive development, but you have less time and flexibility. Your probability curve rises while your time curve descends. When you reach the opposite end, you have perfect information, but it's too late to act. The opportunity has passed, or the crisis has unfolded. So, the goal is to find the sweet spot in the middle, which I refer to as the Kissinger cross. In this zone, you have sufficient information to make informed decisions and enough time to act deliberately. You seek this sweet spot, and with a touch of humility, it becomes a powerful tool. In the CIA, you never have enough information. You're always striving to gather more, yet you must make assumptions and forecasts because you can't afford to wait for 10 9/11 events to have a substantial statistical basis. You're dealing with the one event you have, and your aim is to prevent the next one.
Jim Rickards discusses the power of narratives in shaping economic behavior. He references Robert Shiller's book on narrative economics, highlighting how narratives, whether true or false, can influence economic decisions. Rickards refers to the Great Depression, noting how the narrative of frugality prolonged economic distress until a shift in mindset towards spending led to recovery. He emphasizes the White House's failed attempt to push a positive economic narrative, despite contrasting harsh realities, pointing out inflation issues predating the war in Ukraine, and attributing energy price hikes more to domestic policy decisions than geopolitical conflicts.
People hear the government say the economy is fine or unemployment is near an all-time low, which is actually, statistically, is true. They kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head, like a 2x4. You know, the propaganda is positive. We could talk about that a little more detail. The reality is harsh, and reality wins. And there's a very good book on this by Robert Shiller, Nobel Prize-winning economist at Yale University. Not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about, 2 years ago, maybe a little bit less, called Narrative Economics. He said, yeah, we got all the models in Phillips curve and wealth effect and various quantity theory of money, and some have a place, some are more valuable than others. But don't underestimate the power of a narrative. A narrative is a story. It's a fancy name for a story, but a story that persists, that grows. And interestingly, in epidemiology, of course, we've just come through a pandemic. There's a model called the SIRE model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model when it's mathematically based and it's empirically validated of how viruses spread exponentially. And you can also use it to forecast how a virus is going to go. Well, what Shiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, just something that spreads. And it can be very powerful. And then eventually it may die out or reverse, but it can be powerful in the meantime. That much I knew. But what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true, and they can be very powerful. But a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was 2 technical recessions. But there was a period from 1929 to 1933, election of Franklin Don and the Roosevelt. And then there was another period from 1933 to 1937. The 37 and 1940 part we leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time, but it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considered of all the people who actually have fallen on hard times. Well, that was the narrative. But it's the worst possible economic advice because it's precisely the fact that people with the money should keep spending. That kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, was elected in 1933, became president, 34, the psychology turned 180 degrees, and all of a sudden, the Democratic campaign song was Happy Days Are Here Again, and FDR seemed to solve the banking crisis and so forth. And all of a sudden, it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market, and unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%, while 15% is still painfully high. But it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, yeah, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models. But it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to deliberations among White House officials, some of the stuff leaks to the press. And I know some of these people. It's like the economy is great. Unemployment is really low. We've created all these jobs since the pandemic. But we're doing a really bad job of messaging. The point is, they're inside the White House. They're frustrated that the positive economic story is not getting out the correct analysis, is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging, it's the message. And this is why I say the propaganda from the White House, if things are great, is at ODs with the reality, which is things are not great. Let me give you some specific data points, because, as I say, I don't like to make statements like this without backing it up. Number one, the inflation was going up long before the war in Ukraine started. So if everything was great until February 27, and then Russia invades, and then all of a sudden the inflation goes up, all right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, Jay Powell was testifying before Congress. He said it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war. Number one, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine. It's because the US counterattack with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. Then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada, then ended new leasing, oil and gas exploration, leasing on federal lands, handicapped. The fracking industry took a number of other steps using environmental tools, climate alarm, government subsidies, etc., to basically, to the extent possible, shut down the US energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling or tripling, really from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And so he wants to reopen leasing. I said they shut down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere, and we're begging him for oil. Say, why don't we drill our own oil? Because we were a net exporter up until 2021. And then Biden came in and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. So you wonder why the price of energy is going up. In other words, this damage was self-inflicted. But don't be misled by the headlines, because they're, again, this narrative. I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. So we talked about that in depth. But if you got You're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up. And it has been going up. There's no question about that. And you're like, I'll just sit there and watch it go up. Be careful. We've been warning about a stock market decline for a long time. It's happening. I mean, by the way, the NASDAQ, people forget this because Wall Street is out to sell your stocks. And CNBC says up. The NASDAQ peaked in November 2021. Go look at a 3-year chart and say what was the all-time high of NASDAQ. It was November 2021, and it's been down ever since. Now, it went down and came back, and it's going down again. Okay, there's volatility. And if you're a day trader, fine, good for you. Good luck trying to pick the spots. But the fact is, it's been going down for almost 2 years, and it's going down pretty heavily now because the error is out of the tech balloon. There's nothing I see that's going to make that better. I don't think the Fed's done raising interest rates. We'll talk more next week about what could happen. Yeah, and I remember the 1970s. The stock market peaked. Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, okay, 1982 was the beginning of one of the greatest bull markets in history. Grant that. But 82 is 13 years. It went sideways. Now, again, there's volatility in dips and peaks. I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started. Number one, around 1,000 on the Dow. And when you adjust for inflation, because we had massive inflation in the late 1970s, it was still down. So that's 13 years. Well, we're 2 years into this dip, and the NASDAQ is nowhere near where it was 2 years ago. That's the first thing that's going to get worse because the US is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and that was the number. It was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, people don't realize when wholesalers and distributors build up inventory. That counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise. And particularly in certain areas, stuff goes out of style. And the fashion industry is notorious. Who wants last year's coat or whatever? So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September, sometime around mid to late August, after 2 pretty strong months. And they were strong. The consumers just hit the brakes. Now, they had done enough to make the third quarter strong. But going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. You go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. We were spending not spending. We were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that. But the deficit alone was about $2 trillion. A no Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had, they didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit is used up and the interest rates are 20%. Some of them are 28%. You're going to double that balance in 3 years. If you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 5%. So people are tapped down on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. Gasoline is what economists call the demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shut whatever it is. You're just going to buy the gasoline, even if you don't like the price. By the way, lately price has been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market is starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure